Hey,
Happy
we're
Tuesday,
live.
everybody. Thank you guys for joining us again. Varun, so glad to see that you enjoy these X versus Y series. We like it too. It gives us twice the stock coverage in the same amount of time. So let us know if you guys are here live in the chat, where you are calling in from or where you're watching this from. Brad's from Tampa. John is from Pennsylvania. Percy is from California. Bob is from Bend. Omar from Kuwait. Joao from Portugal. Thank you guys so much for joining us today.
We've got a treat for you because we've got some. We only do the most difficult stocks to do, so we're just going to stay on that.
That's right. That is 100% true. And we are talking today about SpaceX and Palantir. And we are going to be taking both of these stocks through the Simplifier 7 framework. And at the end, we are going to, after analyzing them and talking about valuation, things like that, we're going to tell you which one we think is the better buy. So let us know in the chat, does anybody here own either of these AI tech giants? Stoffel, from a difficulty rating, where would you rate these businesses on the easy to analyze / hard to analyze scale?
So Palantir is now in the hard. Like, I will explain why when from expert to hard for me, but SpaceX is in the 5 diamond hard, just because. I mean, space isn't even the big part of their spending now.
Right.
It's a supercomputer in Memphis, Tennessee. That's where all their money's going.
Yeah, it's like 3 businesses in one. The thing that it's named after isn't even the most important business unit. Starlink is the most important business unit, but we're gonna dive deep into it in this webinar, and we'll also talk about the valuation. Now, that is a very recent IPO, so I don't even know how useful the valuation metrics are going to be, but we'll take a look. We'll use some of our
we'll just punch some numbers in. We'll see what we see.
So to do this analysis, we are going to be using Stock Simplifier. And let's start out with SpaceX. We'll start with the hard ones first. You tell me, am I zoomed in enough?
You could do 1 or 2 more.
That look good?
It didn't change. Oh, there we go. Yep, now it's good.
Okay.
I like the mission for what it's worth.
Yep. So SpaceX mission to build the systems and technology necessary to make life multiplanetary, to understand the true nature of the universe, and to extend the light of consciousness to the stars.
I mean, it's a little bit fluffy, but I still like the multi-planet. Like it does make clear what they're going for here. I mean, anyone who knows Elon knows that he wants to be like the first person on Mars, and he's not hiding that.
Yeah, I love that is the thing here up front. So the funny thing is, because it's in communication services and diversified, it's assigning it a capital light rating. I would say that is incorrect. It is definitely as asset heavy as it gets, but that's because of the classification here. Eagle-eyed people might notice some differences, some upgrades to Stock Simplifier that we made. So first off, you no longer have to click to get some key statistics. You just scroll right down. So gross margin, 50%, negative operating, negative net, and a hugely negative free cash flow margin, 24 billion in cash, essentially 0 debt. Revenue growth has been about 34% and is trading at 18 times sales. No capital return program at all. The other change that we made is we now have a new technical analysis segment. Now, this company doesn't even have a 50-day or a 200-day moving average.
Long enough.
It is that new, but we actually just launched an advanced chart here, so you can see price and volume and things. And if it's available, you can do 50-day and 200-day moving averages, but SpaceX just doesn't have those yet. So more enhancements are here for Stock Simplifier. But with that, let's dive into the business. Okay.
I like that. Let me just say this first sentence might be the most well-written AI sentence to capture SpaceX's business.
SpaceX is a rocket company that grew into a satellite internet company and now an artificial intelligence company.
That is what almost no one who hasn't read the S1 knows about that last part.
And it flies payloads to orbit on partly reusable Falcon rockets for commercial, military, and NASA, and it's testing the larger spaceship. It sells Starlink internet to homes, businesses, ships, planes, and governments. That's the crown jewel business.
I
And the
use it when
newest,
I'm in Costa Rica.
there you go. You're a customer. The newest line, added in early 2026, runs the Grok models, the computer behind them, and advertising. So Starlink is the largest line in the profit engine, billed to homes month to month, while launches are sold contract by contract, and the AI line spends more than it brings in. What holds it together is cost. Reusable boosters and launch rate rivals have spent decades chasing. Keep the price out of reach for low orbit. Keep the price of reaching a low orbit, and the businesses run spectrum, orbit slots, landing rights, and the U.S. National Security Launch Certificate. So pretty good overview. Who are the customers? Households paying a monthly Star internet bill. That's Mr. Stoffel. Not the governments and commercial customers that buy SpaceX rockets. The group that carries the business.
Yep.
Enterprise, maritime, and aviation operators buy the same connectivity for ships and planes. Governments buy it for NASA and crews on the Starlink lunar landing. National security launches and advertisers on the Grok model. Launch buyers weigh SpaceX against Blue Origin's New Glenn and United Launch Alliance Vulcan, and pick the rocket flying today after New Glenn hit a thrust anomaly in April of 2026. Thrust anomaly.
An atomic bomb.
Yeah. Starlink subscribers compare it with Amazon's Kuiper and older services like Viasat and HughesNet, and choose the network already in service since Kuiper began deploying only in 2025.
And I got to say, Brian, I've used Starlink since it first launched, because we're on a remote hill in Costa Rica. It has improved so much, and it is so good that you'd have to pry that from my hands.
Awesome. So that's a high-level overview of the business. New visuals that I just freaking love. So connectivity is the 60% segment.
That's Starlink.
Space is 22%, and artificial intelligence is 17%. Growth rates. So connectivity is growing 50%, space is 8% growth, and artificial intelligence is 22% growth. And we don't have longer term data than that, but 18 billion in total revenue. Isn't this visual awesome?
Yeah, I like that.
69% US, 4% Canada, 10% Ireland, and all other countries are 17%. How predictable is revenue? Very predictable because of Starlink. The largest line is billed monthly. So revenue here is actually predictable. Can it raise prices? Launch has a few real alternatives. So SpaceX prices it above struggling rivals, but Starlink revenue is falling on mix, and the AI line faces bigger players. So it's not dominant.
But it's worth noting that the Starlink falling is very much we've got the Brian Stoffels of the world who are willing to pay this. If we want to roll this out to sub-Saharan Africa, you can't charge the same prices.
So the U.S. is most of revenue, but if you charge it elsewhere, just like Netflix, they charge way less internationally than they do in the U.S.
That's a great comparison.
Yep. So how recession-proof is it? It is recession-proof. Home internet is a must-pay bill, and the launches and stuff like that are independent, and AI is. What's the competitive position? Dominant. SpaceX flies most of the world's launch orbits. So
I can't disagree with any of that.
Yep. So from a business quality perspective, 5 out of 5?
Yeah.
Yeah.
Wait until we get into the AI component and all that stuff. But yes.
Next question, phase. Which of the 5 phases is it in? This is a phase 1, a startup. SpaceX is investing heavily ahead of profitability. Revenue is growing, no profits, and it's reinvesting everything. And it's pretty much been in phase 1. So we only have 3 years of data. Revenue is growing. Profits are mixed. Was it accidentally profitable here?
I wouldn't say it was accidentally profitable. It just was. That was before they started building the supercomputer in Memphis. Colossus.
There are stock buybacks of $1 billion, but the share count still rose. So even if they are buying back stock, the net result is diluting. So that does not qualify them for capital return. Definitely a phase 1 company.
We haven't even mentioned that Twitter is technically a part of this.
Right. Well, that's in the Grok, right?
Yep.
SpaceX has a narrow moat. So this is the current moat. A dominant launch cost exists in 2 lines, but the consolidated business earns no excess return yet. Real cost and cadence edge. Reusable rockets are cheaper than any rival, and they're building the network. No excess returns today. Broadband is profitable, and the lead is commanding in launch and broadband, but weak in AI. That's capping the with moat. So if we were just talking space, 5 out of 5.
Yeah. Well, I don't know if it would be, be hard to say, but if it was just the launch business and Starlink, at least a 4.
Sure.
Probably a 5.
Yeah. Yep. But moat direction, the moat is widening. The launch cost gap keeps extending. The constellation compounds with scale with no source material eroding. So it has a huge cost advantage. The network is compounding from Starlinks, and no rival is closing the gap. So would you agree with this?
Largely, yes. I will say that if Rocket Lab launches the Neutron, they're still not going after the exact same payloads, and who knows, maybe those are the only 2 that gain all the clearance you need with Blue Origin over the next couple of years. That's the wild card, right?
Sure.
Like there's 2 or 3 that can do this, but no one's doing it anywhere near the scale that SpaceX is.
So are there switching costs for consumers of Starlink? For sure. The scale help. The network effect does help with Starlink slightly. How strong is the IP? It's a synonymous brand name. Is there a cost advantage? To me, the cost advantage here is the big one.
It is, but I will say with the IP, there's also just the real estate that Starlink has in low Earth orbit. We shouldn't overlook that because they own really valuable, like they have very valuable real estate in space.
So I would rate this 4 and 5.
Well, yeah. I mean, the tough part is, again, when we look at the financials, you'll see how much cash the AI segment is incinerating right now. So it's like, well, how much weight do we give space? How much weight do we give Starlink? How much weight do we give AI? And
if you do it by revenue, though, the AI is only 17% of revenue.
True.
Plus, is that number is growing like $1 billion a month because of
because they just signed those contracts with Anthropic. Yes.
Right. Everything we've seen has been trailing looking, right? And it's like the forward looking numbers aren't yet in this analysis, or they're not yet in the financials, even though we know that they're there.
Correct.
So that will help.
Yes. There's no doubt that will help.
That's like, isn't that like $20 billion in annualized revenue or something like that? Like around
I don't want
that
to get the
scale.
number wrong, but it's a huge number.
I think it was $1 billion a month at just Anthropic. If you could look those up.
Yep.
But I'm happy to go 4 or 5. Feel free to disagree with me later.
All right. 1.25 billion per month
for both.
For 1.25 billion per month, Anthropic is paying for access to their compute.
Isn't Google also paying?
Oh, all right. I'll check that next. Yeah, I do remember that Google is paying, but Google's got some very loose terms. Google,
they were like month to month, I think.
Yeah, I don't have that number. I'll find it. Oh, here we go. It's about $1 billion a month.
So that's 2.25 billion per month of new revenue that's not in these numbers yet.
Yes.
And
all right, so I'm okay with the narrow moat. We'll give it
their whole revenue was 18 billion for last year.
Yep.
So
and Anthropic's already saying they'll pay. Anthropic on an annualized basis is 15, add in another 11. That's $24 billion just for the compute side. Now, we don't know what kind of margins that gets.
Sure.
Because that's the big question for the entire industry right now. Yep. Like that's why the industry's freaking out right now.
I'd imagine the margins are decent on that much scale. All right. Analysts expect revenue to grow 85% next year, an exceptional pace, and even setting aside the newly consolidated business, the core has compounded at about 30% per year. So 85% growth this year to 34.5 billion against a step up faster than anything. Consolidation lifts the numbers. The legacy base grew 15% in the latest quarter, but so much of the forward jump is the first full year of the newly consolidated AI line.
What we just said.
What we just said.
Yeah.
Organic engine is fast. Even setting the AI line aside, revenue is about a third this year, carried by broadband base that more than doubled.
I just think that people might not appreciate just how big those 2 announcements were.
Huge.
It was like just dropping tons of cash into their
and they were made during like the roadshow process right before like going public. So yeah. Is the industry growing? No doubt about it. All three of their industries are growing. Can new offerings drive growth? This is one of Elon's strongest traits. Starlink didn't exist, and now it's the biggest. When they started SpaceX, they didn't think Starlink. That was something they thought of after going through. So does this company have optionality to launch new product segments? 100%.
Yep.
100%. So 5 out of 5 for growth.
Yep. No disagreements there.
Management assessment. This should be interesting.
Yeah.
So AI gives him a 3 out of 5 rating. Elon Musk built the leading launch business and the largest broadband network from nothing and still runs the company. A few record teams can claim, held back by an unproven AI bet. So the founder's still in control, been there for 20-something years. As CEO, chairman, and CTO, it's his way or the highway. The operations are great, but the bets are unproven. That's fair. He's betting big on AI and concentration.
I've got him owning 36% of shares outstanding, but I believe he has controlling voting rights.
This says 49%. I think that's
there you go.
Yeah. So the way that they count it might be different. I'm pretty sure it's half. I'm pretty sure that this is accurate.
That is the number I've seen before too.
Yeah. And how much that's worth is, varies with the stock price. It was at one point $1 trillion, but now I think it's gone back down. Maybe it's half.
Probably
that,
about 750 billion.
Plenty. Does he have skin in the game? Yeah. He's been post-economic for a long time. 84% of the voting power through a multi-class structure. He also the CEO of Tesla and owner of X. Do employees like working here? Thousands of reviews. They give it a 3.8 out of 5.
It's actually not bad.
Given how hard he works them. Do they beat expectations? We don't know yet. Are they shareholder friendly? Probably not. How strong are the margins? Not particularly strong right now. So it's judging him based on the things we like to judge CEOs by. But personally, I'm an Elon fan. We don't even have any estimates versus they haven't even reported their first earnings yet. I don't think.
Nope.
I would give it I go 5 out of 5.
Personally. We can get in later about just the impending, the assumption of an impending merger with Tesla change the math here.
Talk about making things even more complex, right?
Yeah.
All right. Risk. SpaceX burst cast by design. Free flash flow is negative 14 billion. Lens on forces it can't control and depends on one customer for a fifth of revenue. Offset by a huge cash balance. Heavy losses by design. Forces outside of its control. The strength keeps it from worse. Also, the number we saw for balance sheet, didn't they raise like 75 billion at IPO?
Yeah, so that will be higher.
That'll be like 100 billion.
Yeah, it's going to be much higher.
Plus this negative 14 billion in free cash flow
is going to be much higher.
Well, you say that, but that doesn't include the 2 billion in revenue per month that they're getting.
It doesn't, but I think so. Here, look, I'm going to look up what is the expected free cash flow. So they're expected in 2027 to have free cash flow. Now, this is an estimate on a company that has only been public for a month. So take it with a grain of salt. But free cash flow in 2027 is expected to be negative $72 billion.
Okay.
Now, who knows if that's what's actually going to happen?
That still seems crazy high for given their announcements. But
I totally agree.
How much faith do you put in any estimates about this company, given all the moving parts?
Pretty grain of salt.
But high level, risk level. They have concentrated revenue with the U.S. government, and now with Anthropic and with Google. So those are going to be revenue concentrators. Is disruption a threat? I would argue they're more of the disruptor than disruption being a threat. How much is outside of their control? A lot of government stuff going on in there. That's for sure. How healthy are the financials?
It's got more cash.
Ugly, but they have plenty of cash. High risk. They're 1 out of 5.
No doubt.
They're as risky as it gets.
Yep.
All right. Valuation time. Boy, should this be interesting. We can use price to sales. It's suggesting price to book, which makes sense because it's a phase one company. But we could probably do a reverse DCF on this business.
I think we could.
if we make some assumptions. So based on the stock price of $109 per share and 5.8 billion shares outstanding, that gives us a market cap of 60 billion. And if so the current free cash flow margin is hugely negative. Yep. So let's assume
I think a 20% is fair.
A 20% free cash flow margin is an assumption.
It's so hard to know. I mean, again, the free cash flow margins for the AI business is exactly what the market has been panicking about for all AI companies over the past month. So this could be 30%. It could be 10%. Playing with this tool is the key, not trusting what Brian and Brian put down, but playing with the tool. Now, if we do the split growth, Brian.
Yep.
I looked up the numbers. They are expected on average to roughly double their revenue each year for the next 3 years.
All right. So 100%.
Yes.
Okay. So in other words, if you assume that revenue is going to double this year in 2027 and 2028, which is our roughly estimates, the thing we're solving for is what is the imply, and they can get to a 20% free cash flow margin. Yep. The thing we're solving for here is what is the revenue growth rate from years 4 through 10 that justifies today's stock price. Correct?
And yeah, and I mean, that's not a ridiculous number we got. Now, the assumptions we put in, you could argue are ridiculous. Putting in 100% revenue growth for 3 years.
Let's do 80. How about that?
Sure. So that's good because it shows how sensitive this is. Because 15 and 22 are very different numbers when they have to compound for 7 years. Right. Very different numbers.
Yeah. If we also do a 20-year, well, yeah, let's keep it at 10. That seems realistic. So if you buy that revenue growth in the next 3 years is going to be at least 80%, then years 4 through 10, the company just has to grow 20% on top of that for today's stock price to make sense. So
I'm with Varun here. Like, it's actually not quite as expensive as it looks.
It looks insane on a multiple basis, right?
Oh,
but,
I mean,
that doesn't account for that doesn't count. So here is what today's price would require. And again, this is assuming a 20% free cash flow margin.
Yeah,
a 20% free cash flow margin today. So are there assumptions built in here? Oh, yes. Absolutely. Lots of assumptions. But if you believe a 20% cash flow margin is realistic, even if we dial that back to 15%, that's probably a little more conservative than 80%. Yeah. Still not insane given this company's growth profile.
I mean, it has, because think about this. So Starlink, that could have anywhere from 30 to 35% free cash flow margins.
Yep.
AI, which is XAI, Grok X, that could be anywhere from 20 to 30 or less. Yep. I think 30 is definitely the high bar. Let's say anywhere between 10 and 30, and we don't know. And then space, I would say, is a narrower, like 15, like high teens.
Yep.
To me.
Yep. Now, AI here is saying it's an attractively priced, but that's based on what, 30 days of history. Yeah. So the AI here is programmed on trailing multiples, and on a trailing multiple basis, it does look cheaper than it's been.
I think we should put this one up for a vote real quick. Just see what folks have to say.
That's
1 to
fair.
5.
That's fair. 1 to 5. What do you guys think of SpaceX valuation today based on the multiple and based on the reverse DCF? So 1 is crazy expensive. 5 is cheap. And I would not put all that much analysis. I don't put all that much weight into using the multiple here.
We've got, I would say our average is between a 2 and a 3 so far. Yeah. But anywhere between 1 and 4. I would go with a 3 myself.
I'm going to go with 2.
Okay, that's fine.
I agree. There are reasons to think 3. But you're still even.
Hey, Bob gave it a 5.
Given that this requires essentially 80% growth for the next 3 years, right. And this year's is pretty much locked in unless Google pulls out, which they totally have the option of doing that as a reminder.
I don't think they will.
I'm gonna go with 2, but I don't think it's I don't think it's a 1.
No, maybe a month ago it was.
Yeah. All right. So here we have a total score. So we gave this a 5 out of 5 rating. It's in the startup phase. Moat's looking good. Moat is growing. The growth is very high. Depending on what you think of Elon, personally, I think he's a 5 out of 5 CEO. And if you need proof of why you say that, he has a really good execution track record. Not a time.
No,
he doesn't deliver on time, but pure execution. He's great. The risk here is very high, and the valuation, which is not included in that composite score, is really good. So for me, I'm gonna just put this on my watch list. For now, I'm gonna set a price alert. Sure, let's say $100 a share is when I would personally start to get really excited. Let's go ahead and save that. Cool feature here is now you can check out this 1-page summary. I'll just zoom in so you can see it. 1-page summary of everything that we just talked about, all the business characteristics, the phase that it's in, the moat sources, management, the growth rates, the key metrics, the valuation, all that kind of stuff based on the numbers that we just put in. So really cool feature there that users asked for. And we said, all right, that's a great idea. Let's go ahead and build that. So now that should be built into my dashboard.
Under watch. Yep.
Yep. If you guys want to try Stock Simplifier, the tool that we are using, if you could share the link will get you a 7-day free trial of basically doing everything that we're seeing here on the screen. All right, let's move on to Palantir, PLTR. All right. Palantir, 300 billion. So half the size currently of SpaceX. We build software that empowers organizations to effectively integrate their data, decisions, and operations.
It's actually just a quarter of the size of SpaceX. SpaceX is $1.5 trillion.
Oh, okay.
I know it's big. So I think it's an okay mission statement. It's not amazing. For me.
It's not really a mission. It's really like what we do.
Yeah.
Obviously, a long-term market beater, and this one we actually could do some technical analysis on. I know that you're a fan of this thing, so technically it's in a death cross now from a purely technical standpoint. But let's take a look at some numbers. Market cap 300 billion, founded 20 years ago, almost the same year as SpaceX. 4,000 employees, 4 billion in revenue, great margins. Outstanding free cash flow margin.
Unbelievable margin.
Right? 7 billion in cash, just 300 million in debt. So beautiful balance sheet. Revenue growth in the 30s for 10 years, and that's been pretty consistent. 66 times sales, but only, air quotes, 141 times free cash flow. Given the insane free cash flow margins that this company puts up and no capital return program in place. So business. Palantir sells software that lets large organizations pull scattered data into one place and act on it. Foundry, the company's core platform, handles data management, analytics, and workflow, building around a map of real-world things a business runs on. AIP, isn't that artificial intelligence something? Platform is the artificial intelligence layer connecting the outside language model so customers can build. Gotham provides defense and intelligence, and Apollo delivers daily upgrades. The software runs in the same classified on-premise and cloud settings. Okay, customers pay for platform access plus the operations and maintenance works that keeps them running. And the revenue is generally recognized over the life of the contract. The setup is unusual. This is key thing about Palantir. They do not collect or sell the data, so customers bring their own, and the deals often open a short, low-cost pilot that converts into a long-term contract trial.
All right.
Good.
Can I talk about those two things for real quick?
Please do.
Thing number one, for a long time, I didn't get what Palantir did. And then someone said, it basically just builds a digital twin of your business. And all of a sudden, it was like the light bulb went on. And I was like, oh, because I know that if you run a huge business that's been around since 1900, you've got like 50 different ways of collecting data about your shipping trucks in South America and your HVC in North America and all these things. And it takes all of it and puts it in just one place, one dashboard. And so you can see how a delay, like a production delay in Argentina might affect the prices of what you're selling in Budapest. Like it could estimate that. And the simplest way of putting it, Brian, is, do you remember the first time you used mint.com or something like that? Mm-hmm. And you had all of your financials in one dashboard?
Yep.
To me, that's like the ultimate simplified version of what Palantir does for way more complicated stuff.
You have your checking account here, your savings account here, your investments there, but whatever. Yeah.
And then the other thing is this, the way that they get people to buy it is fascinating, because they had such a hard time convincing big companies to sign on. So they changed it up with forward deployed engineers, FPEs. And they went out and they said, hey, Johnson & Johnson, as an example, send us whoever's in charge of your digital stuff. They can come to our campus for 1 week. We'll build a tool for free. We'll pay for everything. It's totally free. They will come back to you at Johnson & Johnson headquarters with a new product that we develop, and you can use it for free. And they were betting it would be so good that people would just buy it in droves. And if you look at the revenue growth rates, you can tell, we can get to it. You can tell exactly when that happened, because it was going down and then it went poof, through the roof.
Okay. So the buyers are institutions whose data sits in disconnected systems and whose decisions depend on joining it. Exactly what you just said. Mm-hmm. So defense and intelligence agencies are one group, civilian bodies are another, and large commercial enterprises are a third. The first two are governments, and the business is the larger one. Most buyers sit in the U.S. Commercial buyers arrive having already tried it themselves, first building their own and the patchwork of custom software. And then the company names its competition as large enterprise software companies, government contractors, and system integrators. What they buy instead is a way to join the data they already hold and act on without handing it over. Usually starting over a short period, defense and intelligence buyers use Gotham to run missions. The split, 54% government, 46% commercial, growth rates undisclosed, 74% revenue in the U.S., 10% UK, everywhere else, 16%. So largely a US-based business. Quality checks. Is revenue predictable? Extremely predictable. These are enterprises. Enterprises tend to have extremely low cancel rates, right?
Yep.
Can it raise prices? It says easily. How recession-proof is it? It's recession-proof. And what's the competitive position? Dominant. Quality checks. Business checks. Let's go.
5 out of 5.
5 out of 5.
No brainer.
5 out of 5 business. Absolutely. All right. Next check. What phase is it in? It's a phase 3 company, operating leverage. It's profitable and it's reinvesting. So not in the capital return phase. Look at that revenue growth. Very smooth.
The growth rate is accelerating.
Yeah.
That's crazy.
Yeah. So they 10x'd operating cash flow in 4 years. And they were buying back stock, but negligible, and the share count is still rising. So even with buybacks, if the share count is still rising, you are not in capital return. You are in operating leverage phase. That's totally appropriate. Good. I agree with the AI. Moat. Oh, it's once again giving a narrow moat here. I'll read off and then you react to it. Narrow moat, the deep contract lock-in with no second source at full strength, and the return record's just 3 years old. So one source of full strength, the multi-year contracts, returns are young. So they're measuring this based on return on invested capital, and there's no structural cost clause. So they don't have a cost advantage. Your thoughts?
I still think if you have 50% free cash flow margins, and even, we could look at operating margins too. At worst, this is a 4 in my opinion.
I agree. I would say that I would give this a 5. For
the only caveat is with 50% free cash flow margins is a lot of those free cash flows are unearned revenues from all the new customers they're getting. But then you could counter that and say, well, they're getting all those new customers because they've got a moat.
Exactly. And the moat is widening. Contracts grew 112%. versus 85% revenue growth. Margins are fantastic. Commits are outrunning revenue. 3 years of expansion. A new layer is added. AIP governs customers' AI workflows in production, a place to embed them further. They're layering in more products on top of that. It's getting harder and harder to leave. I am personally happy to say 5.5.
It's fair.
Great. Growth rate. Analysts expect revenue to grow 72% next year.
Yep.
To $7 billion. A consensus of 30 analysts sitting just above management's own guidance. That is a massive acceleration.
Yeah. So last year it was 56%. This year it's supposed to be 73, and then it's supposed to fall, I put that in quotes, down to 45% ish for 2 consecutive years after that.
So revenue growth is very high, and this is totally an acceleration based on what we've seen. Was 1.5, now it's 5. Earnings were negative, now they're positive. Is the industry it's growing in? Absolutely. Can they launch new things that drive new revenue? Yeah, absolutely. They've clearly done that. They've done that. So 5 out of 5 growth.
Mm-hmm.
Management.
This is just like Elon. There are people out there who will give it a 1, and there are people out there who will give it a 5.
But a multi-year track record. But a multi-year track record. I know.
Execution, I don't think there's any question.
8 beats in 8 quarters. I remember at one call he said we eviscerated guidance, and I was like, yeah. The best cash margin in the peer group, and a founding chief executive of 21 years set against a share count that rose every year. Excellent execution. Mm-hmm. Dilution is the weakest spot here. So the diluted share count has risen quite rapidly due to extreme stock-based comp. He owns $14 billion of it. Do employees like working here? Similar results to Elon. But do they beat expectations? Absolutely. The execution here has been green across the board. 100% revenue beats, 100% earnings beats. The only thing that I care about with management teams, or the thing that I prioritize most, is execution. To me, this is a 5 out of 5 leader. Yep. He executes.
I agree.
Risk. This says 3 out of 5. What are the biggest risks? Government dependence on a single federated statute is real exposure. No customer is 10% of revenue, and the company holds $8 billion in cash, tons of free cash flow, and no debt. So the biggest risk here is that government is a big portion of revenue, but it's not even 10%.
To me, there's 2 things. One, they've got a 20-year relationship with the government, and I do see how Palantir could get caught in the crosshairs depending on how elections go. But I mean, there would have to be something seriously wrong for the government to leave when you integrate all those systems.
And it's still not even a 10% number here. So one customer is 25% of accounts receivable. I'm guessing that's the government.
That's the government. It's got.
But they're still billing them. Is disruption a threat? To me, this is the disruptor. How much is outside of their control? A majority of revenue relies on U.S. government appropriations and one federal statute, and a large portion are in a single country. That's fine with me. How healthy are the financials? 5 out of 5. So this is saying 3 out of 5 for business risk.
The reason it's saying that is because of the government dependency, but that does not bother me.
I think it's a fairly low risk business. Yeah. Again, not valuation, business. So this says moderate. I think it's a low. Valuation time.
Oh, boy.
Now we have lots of multiples.
Okay, but here's the thing. Look, it's in the green now against a short history and ridiculously high numbers, but still.
Yep. So judged against its own 5-year history, which is using the price to earnings ratio that is in the green zone. Price to free cash flow is a little bit later. Again, this just judges it against its own history here. Mm-hmm. So way higher than the S&P 500, way higher than the peer group and all that kind of stuff. But if we go on a price to sales basis, this was 120 times sales. Now it's only 60 times.
What was it in 2022? Sales. I'm just curious. What did it get down to? It's even
The
7
low
times
is
sales
7.
isn't cheap.
Yeah, the low was about 7. If we go max, yeah, it got down to 7 times sales and up to 120 times sales. So the 6-year average, I mean, what does that even mean? Is about 34. How often is it in the average? Never. But yeah, that gross profit's going to be the same. And if we go price to free cash flow, the price to free cash flow average here is 100 and what's that?
It's like 135, 140 maybe.
Yeah, there you go. 130 currently. So it's currently below its 5-year price to free cash flow rate. If we go price to earnings, and these are all trailing numbers, still very high in absolute terms, but lower in that. This to me is a great reverse DCF company to do it on.
So let me ask you this. Right now, it is stupid high free cash flow margins. Do you believe, I'm starting on the bottom here, but do you believe it can keep those 50% free cash flow margins?
They're currently 50?
50 in the most recent.
Yeah, you're right. It actually maxes out the toggle here. We have it maxed out at 50.
Yep.
But that's what they're doing. Given the nature of the business, and that includes prepayment up front, yes, I think so.
I mean, I just like to build it's actually at 51.5% over the last 12 months.
So you want to build in some, you want to lower that?
Yeah, well, I just want to build, like someone just mentioned in here, what could Anthropic take their business? Just for mental safety, they put it at 45.
Okay.
Yeah. So, all right. So do 45.
You're pricing in a reduction in free cash flow margins. Okay.
Yeah. And for the split growth, they're expected to do over the next 3 years, if you compound it, between 50 and 60% per year for 3 years. So you choose your number there.
55.
And I feel comfortable giving it a 3% terminal growth rate because I believe if they've got the moat that we think that they do, they have pricing power.
Okay. Is 10-year what you want?
Yeah.
All right. So we're assuming in this reverse DCF that margins, free cash flow margins, drop to 45%. If you hold them steady, we'll drop them. Sure. That makes sense. And then we're assuming 55% compound annual revenue growth over the next 3 years. They're going to grow 70-something% this year. Also, think about the execution track record here. They've beat
I mean, look,
8 out of the 8 last quarter.
You could put 63, 64% just to see what it spits out. Like, I'm just curious. So we're saying basically it needs to grow in the low 20% revenue range from year 4 through year 10.
4 through 10. Yeah. After that. So this is what the free cash flow is assuming. So this is what has to happen to free cash flow over the next 3 years. And then this is what has to happen thereafter. So by 2036, the new company needs to get to 39 billion in free cash flow for this model to make sense. And then they got to grow 3% thereafter. So that requires 22% revenue growth in years 4 through year 10.
And let's just say for most companies, keeping 20% plus growth for 7 years is an insanely high bar.
Super hard. But this company has done it for almost 20.
Yeah.
And given their competitive position and everything like that, 100% agree with the viewers saying, well, what about Anthropic? What about AI? Like, isn't that going to come in? But it has to not only clear that, it has to also clear all of the clearances that they have to get to get into these businesses. And then they have to be trustworthy with the data, which is something that is a big question mark if you're a enterprise.
Yeah. So I'm curious. Let's let folks vote on this one. I actually just did this. I'm doing my monthly. I'm just right now in the middle of at the top of every month, I re-rate the valuation of every stock that I follow. So I'll share what I gave Palantir, but I'm curious, 1 to 5, what do people think about the valuation of Palantir? So Chris says it's fairly valued. What do you think?
I'll let some numbers come in. I don't want to influence what people are thinking.
Okay.
But I think the multiples can be deceiving with this company, given the growth rate, given the trailing numbers here. So multiples are far more useful when growth rates are more static or more predictable. I think a reverse DCF makes more sense here, and this is the thing that you're solving. Thing that you're solving for. My personal feeling would be to say it's a 2, my personal feeling. But based on what we're seeing here, I think.
And the winner, the winner from our voting was 4. Now I gave it a 3, but the winner was a 4.
Yeah. So this is the average number that we're seeing here from people that are watching this live is 4. My personal feeling would be to go 2, but between 3 and 4 does make some sense here. So to review, this is a 5 out of 5 exciting business in the operating leverage phase. Moat is wide. Moat direction is wide. Growth is very high. Management is outstanding from an execution perspective. The business risk here is low. And from a valuation perspective, 4 out of 5 is what people voted. I would go a little bit lower than that. Let's go ahead and put this also on the watch list. Let's save the analysis here. Here's that same 1-page report that we can get with everything that we just saw, kind of an overview of all the analysis that we just did. And you can save that as a JPEG. I will close that down. I'm also going to set a price alert on this stock. I'm going to say probably about $100 is when I would personally really start to get interested. So with that, where are we at, Stoffel? So let's review. SpaceX. Actually,
SpaceX, I believe, got a 3.9.
Yeah, well, I have it on my watch list, right?
Okay, there we go.
SpaceX, to review, SpaceX got a composite score of 4.2. 5 out of 5 business, 4 out of 5 moat, 5 out of 5 growth, 5 out of 5 management, 1 out of 5 risk, 2 out of 5 valuation perspective.
Let me just say that's where the big difference is between these two companies. The risk is much higher with SpaceX, which means the reward could be much higher too.
Right.
Although I don't know, because the valuation actually looks better with Palantir.
Then Palantir got a composite rating of 4.8. And from a valuation perspective, it got a 4 out of 5. Well, this call is fairly easy for me to make, but I would love to hear what you think, Stoffel. Which one do you think is a better buy right now, Palantir or SpaceX?
To me, it's no doubt it's Palantir. That's not to say that SpaceX isn't worth investing in, but like I've read the S1 for SpaceX. The amount of money that they are pouring into AI is just insane.
That is the bet.
That doesn't mean that they won't benefit from it by any stretch. But if this was the launch and if it was just the launch business and the satellite business, I bet Elon would argue, yeah, it would be better right now, but we wouldn't dominate the way we could 10 years from now. And he might be right, but I just can't see that. So it's very clear to me Palantir is the choice.
For me, I'm going to say the exact same thing. If I had to choose between these two, I would bet on Palantir. It's already profitable. It is a play on AI. The growth it has a market history. It's clearly been a winning stock. And then on top of that, the market cap is 1/3 of what it is for SpaceX. It's also a more concentrated play. You're betting on software in enterprises with more and more layers on top of that. You're not betting on the AI wild card working out. You're not betting on the SpaceX. Offsetting that, I would argue that SpaceX has more optionality built into it. I think they both have optionality. SpaceX has more optionality. The total addressable market for SpaceX is larger. It's definitely larger. So to your point, I think you could do better long-term upside potential with SpaceX, which is crazy to say, given that it's $1 trillion company, which is three times theirs. So SpaceX, definitely the riskier long-term bet. But if I had to choose between these two right now, I would choose Palantir.
Yep. That's exactly where I'm coming down as well. I agree completely.
And if we look at the company's growth rates, for those that are unfamiliar, we now have full financial statements in Stock Simplifier as well. So we can see the financial statements here. You can download these. You can actually share them and everything to different platforms, or just keep them from your own. And full financial statements are on here. We've actually designed this layout so you can, at a glance, get all of the key numbers here. So revenue, gross profit, operating profit, net income, diluted share count, and more. This is called the simplified view, which we're making. If you want to see every number, you can expand them. If you just want to see the headlines, you can contract them. But we put some time into this simplified number, so that's like all the key information fast. Same with the balance sheet. With the simplified, you just see cash and you just see debt. Cash flow statement, you just get stock-based comp, capital expenditures, free cash flow, and the amount paid for each of them. Let me zoom out too. And you also get all the key metrics that go along with the company.
That.
Yeah, the key metrics are really cool.
Billings and the RPO, those are very important.
So this is reported. This is Palantir's customer count. So total customers, and I think they have US versus total, and you can totally stack them too if you have multiple metrics on here. So we are very open to feedback from our users. For anybody here that is a user, we do have a request feature button here right at the bottom of every page. If you have ideas for how we can make this even better, please click that button, because we keep track of requests that people get.
I don't think I've even seen this. So does that green mean that you've done that?
No, the green means you upvote it.
Oh, got it. Okay. So people can see what other people are voting for.
Yeah. So the number one thing is show source reference in AI prompt answers. So if you like, I like that feature, just click the upvote button, and then we tackle from top to bottom. So what are people requesting the most? I actually don't have on here all the things that we've done and pushed. Yeah.
Well, anyone who's followed this knows we've done and pushed a lot.
So if you are a user of this and you're like, as you're using it, hey, that's cool, or you have an idea, please use this feature. We love to get feature requests from people and find ways to make this even better and even more useful. So thank you guys so much for watching. For both of us, we think that Palantir is the better buy today, and we hope that this session was useful. I am personally going to be in Italy next week, but Mr. Stoffel will be back next week to talk about. We're
going to do Datadog and Snowflake, I believe. And if you want it, you got to come to if you're watching on YouTube, come to my YouTube channel, Brian Stoffel YT, and you'll find us there.
There you go. So I won't see you next week, but Mr. Stoffel will. Thank you guys so much for joining us today, and I'll see you all in 2 weeks. Bye everyone.